Good morning, everybody. Welcome to Tax with Sax Q2 major updates. Before we get started, just want to read you certain disclaimers here that our firm provides the information in this webinar presentation for general guidance only, and that does not constitute the provision of legal advice, tax advice, accounting advice, investment advice, or professional consulting of any kind. The information provided herein should not be used as a substitute for consultation with professional tax, accounting, legal, or other advisors. Before making any decision or taking any action, you should consult a professional advisor who has been provided with all the pertinent facts relevant to your particular situation. Just a few more housekeeping items. For those of you looking for CPEs, you must stay connected to the GoToWebinar for the entire duration of this presentation. We expect this presentation to run an hour and a half, which would give you about 1.5 CPE credits. The participants must answer 75% of the polling questions. If you have difficulty answering the polling question, that is, if your answer does not register, hit the escape key to minimize your screen. Try again. If that does not work, please type that into the chat box. The evaluations are in the handout section of the control panel, and they should be downloaded, completed, and emailed to jtoshi@saxllp.com to receive the CPE credit. Her email address can be found on the form. So with that, my name is Shivani Jain, and I'm a tax partner at Sax. I'm also part of the firm's cryptocurrency practice. I have the pleasure here to introduce you guys to Shehan Chandrasekera, who is our guest speaker today. Shehan is one of the handful CPAs in the country who is recognized as a subject matter expert on cryptocurrency taxation. He is the head of CoinTracker. He writes a lot for the Forbes magazine. He's also won numerous awards in the last couple of years. He's a renowned speaker who has done speaking engagements with many organizations, including Google, Coinbase, Square, CoinDesk, Lyft, just to name a few. So just to go over the agenda on what we plan to cover today, as we know that there is a lot of activity happening at the Hill with the Build Back Better Act. So we'll go over the main provisions of the Act, and then we'll take it into cryptocurrency and how it applies or what provisions could apply. And then we'll go into the crypto-related tax implications. For those of you who were part of our Q1 webinar, we had gone over the basics, basically saying that cryptocurrency is treated as property. So every time you buy, you sell, or you exchange a crypto, it is a taxable transaction. We had also discussed hard forks, and we had discussed airdrops, that how they are ordinary income. And then we went into the discussion about mining. If you're a miner, you do it as a hobby, it's ordinary income, and you report it on Schedule 1 of your tax return. And then if you're doing it as a trade or profession, it would go on Schedule C of your tax return, and you could potentially deduct some expenses related to that. We know that the IRS guidance is very limited on cryptocurrency. We have had 2 notices and maybe about 49 FAQs, but as you know that in the infrastructure bill and the Build Back Better Act, the IRS is now catching up to where the industry is right now. We left off the Q2 webinar, telling everybody that wash sales rules did not apply to cryptocurrency. As of that time, that may change soon, so we'll just catch up on all these provisions. So just to go over some of the proposals of the Build Back Better Act, the first thing is, and I'm sure most people have read about it, is the increase in the top tax rate would go from 37% to 39.6%. That would apply if you're married filing joint with taxable income of $450,000. If you're head of household, $425,000. If you're single, $400,000. Married filing separate, $225,000. And just note for trust and state, the highest tax bracket of 39.6 would start at $12,500. There are changes proposed in the Act for the corporate tax rates as well. Right now, as we know that you have a flat rate of 21%, that is going to change if this Act is signed into law. Just to clarify that whatever provisions I am discussing would be effective January 1, 2022, unless I mention them. There are certain provisions that have a later date or that actually have an earlier date as early as September 14, but I'll mention them separately, but if I don't mention anything, most of these provisions are effective January 1, 2022. So the change in the corporate tax rate would now have a graduated rate phase-in. So for the first $400,000, the rate would be 18%. For the next 400 to $5 million, the rate would be 21%, and over $5 million, the rate would be 26.5%. The benefit of the graduate rate phase out for corporations making more than $10 million will not exist. So let's take an example, right? If you make $9,999,999, right? Your tax liability would be $2.3 million approximately. But if you make $10 million $1, your tax liability could be around $2.6 million. So there could be an increase about $287,000, because once you make more than $10 million, you will not get the benefit of the lower tax rates, which is at 18% or 21%. The lower tax brackets also do not apply to personal service corporations. There's also a surcharge proposed on individuals with adjusted gross income of more than $5 million. The surcharge would be at 3%, and this surtax would also apply to trust and state. I've read a couple of publications where say that the threshold for the trust and state could be much lower, but we will have to see when the act is finalized what is the actual number. Net investment income, this was enacted a couple of years ago, and now the proposal is to actually expand this to even ordinary income if the taxpayer is making more than $500,000 if you're married filing joint. So this provision will also apply to trust and state. So just, if you keep on adding up, probably, your highest tax bracket could be way over 39.6%. You have the 39.6% higher tax bracket. So if you make more than $5 million, you add another 3% as your surtax, and now your ordinary income could also be subject to the 3.8 net investment income. Another provision that was talked about or is talked about a lot is the capital gains and the qualified dividend rate increase from 20% to 25%. So, and that effective date would actually be September 14, 2021, the date after they actually first release the details of this bill. So that's a key date to keep in mind, that if you have long-term capital gains or qualified dividend rate, it could actually be 25%. I want to talk a little bit about the qualified business income deduction. As we know, QBI was enacted a couple of years ago, and if you were not a specified service, trade, or business, mainly, accountant, were excluded from that, or if you were using your skill to earn income, you were also excluded from this kind of deduction if your income was more than $426,000. This deduction, now they're trying to limit it to $500,000 if you are married filing joint, $250,000 if you're married filing separate, $400,000 for the taxpayers, and then the key is here, $10,000 for trust and state. So if you have flow-through entities where trust and state are not grant or type of trust, this could be a big hit if they start limiting your QBI deduction to the $10,000 number. The next provision was carried interest. Certain investment managers, when they get paid a share of profit, they get long-term treatment. So the long-term treatment is generally if you hold it for more than 3 years. They're trying to increase the 3 years to 5 years now. I think this is a big change and generally applies to people who own C corporation stock. There is a provision called Section 1202, or we also call that as QSBS, whereby if you own the stock for more than 5 years and the stock was issued when the entity had total assets of $50 million or less, and you were part of the original issue, the entity was an active business. That means more than 80% of his active assets are actually employed in the active trade or business. You could potentially exclude a part of your gain from taxable income. That maximum exclusion could be $10 million or 10 times your basis. So what has changed, or what is proposed to be changed, is that if your AGI, your adjusted gross income, is more than $400,000, now you cannot get the 100% exclusion of this gain. There was a 75% exclusion rate in between years, so that's why I have it as special 75% or 100% exclusion rate. So if you are making more than $400,000 now, your exclusion rate would be limited to 50% of the gain. Again, the date here is a little different. It is applied to sale and exchanges after September 13, 2021. So if this law goes into effect, this provision would already be in place, unless you have a binding contract to sell. So if you had a binding contract pre-September 13, 2021 to sell, probably you could get the 100% gain exclusion. So let me just give you an example of that, right? So I have a stock I invested initially. I invested $1 million in a C corporation. The assets were less than $50 million, and I meet all the provisions of this. If I had sold the stock for $10 million pre-September 13, 2021, the whole $9 million, which is basically $10 million my sale price and my appreciation, and then $1 million my basis, so $9 million, everything would have been excluded from my income. But now, if I sold it, let's say today, then only $450,000 of the gain, which is $9 million times 50%, would now be excluded from income. So this is a big change, especially for people who had originally set up C corporations. There's also a temporary rule which was included in the proposal, which will allow an S corporation to reorganize as a partnership without paying any tax. So generally, if you liquidate a S corporation, you need to recognize gain, but they are making an exception this year for any S corporation that is completely liquidated and you convert it into a partnership after the act. So the eligible S corporation must complete the liquidation and transfer substantially all of its assets to the domestic partnership during the 2-year period beginning December 31st, 2021. So if you are trying to make this conversion, then you will have a 2-year tax-free period. So I'm just going to take a pause and launch my first polling question. Which of the following is not a digital asset? Sax newsletter, a laptop, CryptoKicks, or Bitcoin? Which of the following is not a digital asset? I have about 35% of the votes in. Just give it about a few seconds more. $85 in. I'm going to close it in 3, 2, 1. So I think most of you did get it right, that a laptop is not a digital asset. So going back to the slide. So just wanted to discuss some other provisions. We will not go in much detail into them. The limitation on excess business loss for non-corporate taxpayers, they are thinking of making it permanent. This provision was basically if you had losses that exceeded your gains from other businesses, your loss would be limited to a dollar amount For 2020, this dollar amount was $524,000. So that's the maximum amount of loss a non-corporate taxpayer could take. The R&D expensing, there was a provision under TCJA that you would start expensing it or amortizing it over 5 years. This requirement is now moved from 2022 to 2025. The next provision is a big one where foreign tax credits will just be limited to carry forward for 5 years. So if everybody remembers foreign tax credit, you could carry back 1 year and then you have the provision to carry forward 10 years under the Build Back Better Act. I'm going to call it the BBB Act. Under the BBB Act, now you can just carry forward the foreign tax credit for 5 years and the carryback provisions are repealed. They've also expanded the work opportunity tax credit to include a certain additional summer youth employees. And then based on the charter which we are hearing from the Hill, Democrats are still trying really hard to eliminate the SALT deduction limitation. Significant changes even proposed to the retirement accounts. So if you wanted to make a Roth IRA contribution and your income was over $140,000, you couldn't do that. So what the workaround of that was, you would make a non-deductible traditional IRA contribution and then you would do a backdoor conversion to convert it into a Roth IRA. So there is a proposal in there, and the effective date, at least on the bill which I read, was December 31st, 2031. So we still have time with that, but I'm not sure if it was a typo or if that's what they intended, December 31st, 2031. But they are going to close this backdoor Roth IRA conversion for any individuals who are making more than $400,000. If you're single, but if you're married filing joint, that amount is $450,000. So there is provision of closing the backdoor IRAs effective as of now, December 31st, 2031. There are also provisions that if you have significant retirement funds in your IRA or your Roth IRA together, which exceeds $10 million, and if your adjusted gross income is over $400,000, or for joint filers, $450,000, I'm sorry, it's taxable income over $450,000, you will not be allowed to contribute any additional funds to your IRA or your Roth IRA. Their annual reportings have also been added to the employers if the aggregate balances in the accounts exceed $2.5 million. In addition to that, new distribution requirements have also been added on these proposals, whereby if you total of your Roth IRA, your traditional IRA, your defined contribution, if they exceed $10 million, you will be required to take a minimum distribution irrespective of your age. And the minimum amount is calculated as 50% of the amount that exceeds $10 million. So you will be required to take a distribution. And then there are different distribution requirements if your balance is over $20 million. I'm not really going to go into the details of that. The changes of estate taxes are also, we have talked about this and we have been encouraging a lot of our clients to actually go for estate planning, but just to discuss a few of them is the state tax exemption would reduce as of January 1, 2022 from $11.7 million to $5 million, which is adjusted for inflation. So that would bring you about $5.5 million. So that's almost close to half of the exemption. So the exemption is slated to go down. Valuation discounts, this is a big one, would be disallowed on non-business assets based on lack of marketability and lack of control. So generally, we try to take valuation discounts for operating business or other entities as well, saying, I have a very small share, I cannot really sell it to anybody, I don't have control over it. So we would take, significant amount of discounts. So now, let's say if you have an investment partnership, but you just have investments as the portfolio of that partnership, valuation discounts will be disallowed. The next two provisions are actually effective the date of enactment. So let's say if the Build Back Better Act is signed into law on November 1, these provisions will go into effect on November 1. It will not be January 1, 2022. So the next two provisions are that any appreciation contributed to a grant or trust after the date of the enactment will be pulled back into the state, into the taxable state. So even if you created a grant or trust and there is appreciation after the date of this enactment, it could be pulled back into your state. And the next one is sale to grant or trust. Again, after the enactment, could be subject to capital gain treatment. So, essentially, if I was a grantor and I sold the stock to my grantor trust, it would be now taxable. Earlier, it was not, because it was essentially treated as, sale to myself, and there was no tax treatment, tax implications to that. So that brings us into, the main part of this webinar, which is virtual currencies. And I said that when we talked about Q2, we said, okay, WAS sale rules do not apply to crypto currencies because it's treated as property. There are specific provisions in the Build Back Better Act, which now would include commodities, currencies, and digital assets as part of the WAS sales rules. And then the constructive sale rules will also apply to digital assets such as cryptocurrency. So just to give you an example of the differences, we'll go over one example of wash sales, and then we'll go over an example of constructive sales. So pre-January 1, 2022, let's say if David buys an Ethereum for $3,000, on January 16th of 2021, Ethereum is trading at $2,000. David sells his Ethereum and realizes a loss of $1,000, a capital loss of $1,000. But he buys the Ethereum back when it was at a low on January 17, 2021 for $2,000 and holds it. So pre this proposal, I could have deducted, or David could have deducted $1,000 of capital loss. So now what's going to happen if this provision goes into law? The same example again, David buys the Ethereum for $3,000 on 16th. He is trading, when Ethereum is trading it at 2,000, he decides to sell it but buy it back on the 17th. WAS sale rules apply for 30 days pre and post sales, just to let everybody know. And he sells it, so he again has $1,000 of capital loss, but at this point he would not be able to take this capital loss, and that capital loss will actually be added to his basis of the Ethereum. So he bought the Ethereum at $2,000. $1,000 of the capital loss is disallowed, so his new basis in the Ethereum will become $3,000, but he will not be allowed the $1,000 of the loss. Going to the example of constructive sale. Let's say if Bitcoin is purchased on December 1, 2021 for $50,000, then on November 15th of 2022, when the Bitcoin is valued at $80,000. So guys, this is probably my prediction of where Bitcoin is going to be in 2022, $80,000. So that's why we use that number. I don't know what Shehan thinks about it, where it's going to be. Maybe Shehan, you think it's going to be close to 100,000?
It's hard to say, but yeah, I mean, people predict that it's going to be 100,000 before the end of the year. I think it's going to be a little too aggressive to think that way, but towards the end of 2022, seeing 100,000 per Bitcoin, it's a possibility.
Yeah. So let's see, if our predictions come true, we can catch up at next year and see where we are. So Bitcoin was purchased in December 1, 2021 for $50,000. On November 15th, it was $80,000. Ideally, the taxpayer would like to wait 12 months to get a long-term capital gain treatment, but then, he's afraid that Bitcoin may actually go down. So he enters into a short position on November 16th. What's going to happen under the constructive sale rule is that he will need to recognize a short-term capital gain of $30,000. The basis of the new Bitcoin, which he will now become $80,000, and the holding period will actually start on November 16th, 2022. So there will be a new holding period. The old holding period does not tag on. Let me do a polling question before we go into crypto taxation. Which of the following is not a cryptocurrency? Which of the following is not a cryptocurrency? I have about 31% of the votes in. $75 in. I'm just going to give it like 5 more seconds. Anybody who wants to get in their vote for the CPEs, please do so at this time. Three, two, one. So the correct answer is Pancake Sweep is not a cryptocurrency. So Shehan, there has been a lot of talk about the infrastructure bill and how the provision could be burdensome to maybe the broker houses or the exchanges. And I've had a lot of people ask me that question, when they do the calls with me is how is IRS going to find me if I don't report the cryptocurrency, right? These are all anonymous accounts. At least in the initial stages, nobody would really ask any detailed information. Now I know exchanges like Coinbase have been started to ask your credit card info, not credit card, but your driver's license information and stuff like that, so they can identify you. So what are you hearing about this, and do you think that it's actually going to go through?
Yeah, so the infrastructure bill was a big deal, and cryptocurrency was a big conversation topic when they were negotiating this bill. I think the main thing that they're trying to do is subject cryptocurrency into the same rules that stocks and securities are subject to. What I mean by that is going forward, cryptocurrency exchanges, centralized exchanges like Coinbase and Binance US, and also decentralized exchanges like Uniswap and a bunch of others, they will have to issue you a 1099-B form similar to the form that you're getting from TD Ameritrade or JP Morgan at the end of the year, summarizing your cryptocurrency capital gains and capital losses. So essentially, they're subjecting cryptocurrency to a covered, they're treating cryptocurrency as a covered security. So that was a big news. Obviously, exchanges came in and said it's really hard to comply with these rules because right now they don't have a mechanism to track the cost basis. So and also if you're transferring crypto from, let's say, from Coinbase to Binance US, going forward, Coinbase has to inform Binance US your cost basis. It's called the cost basis transfer mechanism, which exists in the stock world, but in the crypto world it doesn't exist. So exchanges, will have to, spend significantly on their, internal accounting system and etc. to kind of track these things and, report forms correctly. And also, it's going to be hard for them to produce complete 1099-Bs because in the crypto world, self-custodying your assets is a common thing. Say, for example, I have my Bitcoins in my hardware wallet. I send that from my hardware wallet to Coinbase and then, sells at Coinbase for like 50,000. And then Coinbase would issue me a 1099-B saying that, okay, I sold this coin for 50,000, but Coinbase would not have any visibility into how much I paid for that coin because that purchase never happened inside the Coinbase. So those type of transactions going to be super common. So you're going to get, a lot of 1099-Bs with missing cost basis, and then it's going to be your responsibility to kind of reconcile those cost basis errors and etc. And another way to kind of think about it is that there's a lot of decentralized exchanges that are in the market today. And for example, if you take an exchange like Uniswap, you can trade cryptocurrencies peer-to-peer without ever having to, even give your email number, email account, or the name or the social security, etc. So, and then the new infrastructure bill is subjecting even those type of decentralized protocols to 1099-Bs. But enforcing those laws at that decentralized level will be pretty challenging. In my opinion, it's not going to work because there's no CEO or anybody to kind of send these, letters to say that, okay, your users, are subject to 1099-B reporting. So all in all, I think I like, what the Congress and the regulators, what they're trying to do is replicate what worked in the substance security world 10 years ago in the crypto world. But in my opinion, it's not going to be very effective because crypto is different because of the example that I mentioned. There's sort of self-custodying in the market, and then there's decentralization is happening where you can do anything without ever having to give your social security number or any personal identification information. So that's the main thing about the infrastructure bill. And then the third point, actually the last point here is that, so this is a situation where, like, let's say, like, you're going to a dealership and you're paying 1 Bitcoin and buying a Tesla or something like that. In that case, going forward, dealership has a requirement to disclose that transaction to the regulators. There's no taxes involved here, just like you just had to file a Form 8300. And the dealership, the business, has to report to the IRS that, okay, I received this much of Bitcoin from this person. This is the social security number of that person and personal identification data. So that's a fourth point, and that's something that businesses have to abide by going forward.
So Shehan, what about the question that, how is IRS going to get me if I've not reported it so far?
There are a few ways that IRS knows you have something to do with crypto. Number one is whenever you answer that virtual currency question, either yes and no question, so your answer probably gets stored in some type of database. And in the future, I'm pretty sure they're going to do some type of matching, and they're going to kind of match that tax information with your exchange information and kind of come up to you. Number two, which is very effective, is IRS can issue subpoenas to exchanges. Like 2017, 2018, IRS issued subpoenas to Coinbase. In 2021, we saw 2 subpoenas going out to Poloniex and Kraken. And if your name gets leaked, through one of those subpoenas, then you're more likely to, get like some type of tax notices down the road saying, okay, you didn't report this much, you need to amend the return. Or even if you did report something, you got to show us how exactly you calculate your capital gains and capital losses. So that's the other way. I think the third way is that IRS has the criminal investigation division has pretty sophisticated technology. They're partnered with chain analysis, CipherTrace, and etc. So they have technology to kind of connect online transactions, IDs, and etc. into real world people. To catch people who are using Bitcoin and other cryptocurrencies for illicit activities. So those are the 3 ways that the IRS know that you have something to do with cryptocurrency. And last but not least, if the exchanges are issuing you any type of 1099 form, could be a 1099K, 1099 miscellaneous, or even a 1099B, because some exchanges do issue 1099Bs even today. So if you have one of those forms, that means that information has already been reported to the IRS by the exchange. So if you don't report that information on your taxes when you file your Form 1040, IRS is going to issue you like automatic notice, because IRS is going to match what you reported on your 1040 to what the exchanges have reported to them. So those are the 4 ways that the IRS knows that you have crypto. The summary here is that crypto is not anonymous. It's in most cases, the regulators can find out the true identity behind who's doing those transactions. It's not anonymous, so you should be compliant with the tax reportings.
Yeah, and do you think, Shehan, that this kind of reporting will also apply to NFT marketplace exchanges? Exchanges which actually sell non-fungible tokens.
Yeah, because if you look at the definition, they're referring to this thing called digital assets. I believe, I don't remember the definition on the top of my head, but it's any digital representation of some other asset. So in in my view, yes, NFT is a digital asset, and those platforms would come under the infrastructure bill scope.
Yeah. So, Shehan, you want to jump into staking of cryptocurrencies? I think that's really picking up a lot. And what are you seeing around the marketplace?
Yeah, so staking, for those of you who don't know, staking is very similar to the way our savings account works. So you kind of keep your crypto in some type of protocol, wallet, or an exchange, and that crypto coin has to support staking functionality. So you just keep it there, and when you stake, you kind of verify transactions in that blockchain. And when you do that, you get these rewards every second, every minute, or whatever the frequency that that they set. So it has become very popular because it's a passive way of making money. You're not trading or anything like that. You just leave your funds on a wallet or some place that supports staking, and every day you're getting more rewards. So the taxation, again, IRS hasn't issued any staking specific tax guidance, but it is very reasonable to think that at the time you receive those staking rewards, that triggers a taxable event, and that's considered ordinary income, which you had to pay taxes as well. So that's about staking. And if you're interested, like for some coins that allow you to stake are Cardano, Tezos, and even actually Ethereum as well. So now you can stake Ethereum.
Yeah. So just to elaborate a little bit on what Shehan was saying on the, when is staking income tax, and then we'll just go also, what kind of income it is. So the timing is generally upon the receipt, when it actually hits your wallet, that's when staking income is recognized. But there are cases where, you don't have the right to sell it, the stake rewards right away. You cannot trade it, you cannot transfer it. So it's almost like locked in. And in that case, probably our thought is that you recognize the income when you predominantly get dominion or control over the reward. So it could be that, they have hit the wallet, but they are kind of locked in. So if that's the situation, you do not have the rights to sell them, trade them. So, you could potentially take a position that you are going to defer the recognition of income till you get full control of the reward. So Shehan, would that hold true for Ethereum 2, ETH2 staking rewards?
Yeah, so the Ethereum 2 is I would say a unique staking situation. So right now, if you have Ethereum, you can put it on a smart contract, and you can get Ethereum 2, which is just the same coin, but it's going from proof of work system to proof of staking system. But the problem is that when you receive those Ethereum 2 tokens, right now, for the most part, you can see them being credited on your wallet, but you don't have access to it. So in that case, you can defer the income recognition because you haven't gained dominion and control over those coins. But that said, there are some platforms that allow you to get access to Ethereum 2 coins right away. In those cases, you got to recognize income because you have access to some type of wealth. But generally speaking, if you put those 32 Ethereums in a smart contract, you don't have access to the Ethereum 2 coins today. If that's the case, you don't have to report any income.
Okay, so I think it's key, at least for us as preparers, that we ask the right questions, right? Whether those rewards were actually accessible or not to the taxpayer. So what is the nature of this income? You report fair market value as ordinary income upon receipt when you actually get the control of these rewards. So let's say if my rewards, I get Teso rewards and they are worth $1,000 when they hit my wallet, I am going to pick up $1,000 as ordinary income, and we'll go over how it's actually reported. And then if I later on sell that for $5,000, I am going to pick up capital gains of $400,000 of $4,000, not $400,000. So this going over an example that A receives 1 Ethereum as staking reward on January 15th, 2021. At the time it hits the wallet, its worth is $500,000. A should report 500 as ordinary income on Schedule 1 of the 1040. Now, if A sells this reward on January 15, 2022 for $3,000, A will pay a capital gain, which is 3,000 minus 500, it's $2,500. And in this case, because the coin was bought in January of 21 and now it's February of 22, more than 12 months have expired, it becomes a long-term capital gain transaction which needs to be reported. So let's do a polling question before we get into NFTs and the fun part. How much cryptocurrency do you currently own in US dollars? I'm going to close it in about 30 seconds. Most of the votes are in. Okay. Shehan, what's your prediction? How many will be in the 0% bracket?
Probably majority of maybe 0% or 50%. Okay.
Yeah, so 67% said that they don't own, and about 18% said that they own more than 5,000 in cryptocurrency.
Yeah, I mean, so that makes sense. So when I did this presentation, like, you know, probably 3-4 years ago, none of them had crypto, and over the years I have seen you know, people who said zero has, you know, gone from 99% to, like, you know, going down, which is good. Okay, so let me cover the NFTs, but before we go there, I just want to kind of give you some background on crypto. So cryptocurrency at a high level is heading mainstream. Just to kind of give you some numbers, there are over 46 million Americans with Bitcoin today. There are over 200 million people worldwide with some type of cryptocurrency holdings today. There are over 8,000 cryptocurrencies in circulation. If you have time, I encourage you to go to coinmarketcap.com. That's a website that lists all the cryptocurrency that we have today, their characteristics, and etc. So that's the industry. Actually, one more point, our public companies have heavily invested in cryptocurrencies as well. Tesla invested 1.5 billion in crypto. Square and a bunch of other companies are, you know, introducing cryptocurrency services, so they have invested their treasury cash into Bitcoin as well. From the regulation point of view, like Shivani showed, you know, this is a big deal for the IRS, and this is the reason why they put the virtual currency question on the Form 1040. And if you look at the 2021 forms, you know, they're continuing to have that question on the front and center of the Form 1040. So the point that I'm trying to make here is that crypto has become a mainstream subject that every tax practitioner needs to know. This is no longer like a niche subject that you can't ignore. So that's crypto. Now, coming back to 2021, if you ask me what was the most popular topic in the first half of the year in the crypto space, it wasn't Bitcoin, it was actually NFTs. NFTs stands for non-fungible tokens. So these are digital assets created in limited quantities. And because they're made in limited quantities, they're, you know, kind of considered collectible. So it could be a piece of artwork or a domain name and etc. So it all started. NFTs are nothing new. The NFTs, the first NFT projects happened like in 2016, 2017 time, but then there was like a crypto winter that, you know, there was no activity. But all of a sudden in 2021, this artist sold this art called Beeple, as you can see on the picture, for $69 million. And this kind of, you know, kicked off the entire NFT market. And this kind of made in the news. And if you go to the next slide.
Right.
So, and even, people started kind of, selling very, I guess, weird NFTs as well. So in this case, for example, so this person who sold this was, I think he was on CNBC as well. So he purchased this rock, which is literally like a JPEG, for 6,600, and he sold it for 1.8 million as an NFT. Again, I'm just kind of giving you some background, and if you have time, I encourage you to go to these marketplaces like superrare.com, OpenSea, and Nifty Getaway and Variables. These are marketplaces where you can go and kind of search NFTs, and if you like some type of artwork, you can buy them and you can sell them, you can auction them off, and etc. So that's the kind of best way to kind of know about NFTs. But at a high level, these are collectible artwork, and people buy them and sell them because they perceive value in them. So what's the difference between crypto and NFTs? So cryptocurrencies, they're designed to work as a method of payment, right? NFTs kind of use the underlying, the technology that cryptocurrencies run on, which is blockchain technology. But NFTs are different because they're fungible. So if you have, 10 pieces of like artwork, they're different from each other, and that's what makes them valuable as well. And then that non-fungibility is kind of coded in the blockchain, and that's why it gets the value that the market has assigned to them. Okay, I think we can go to the
next slide.
Next slide. Yeah, so NFTs. So obviously you can buy these NFTs from marketplaces, meaning the marketplaces have NFTs that have been created by artists and other creators. You can also mint your own NFT. Like you can create like your art on Adobe or some type of software and kind of mint it as an NFT and place it on these marketplaces. And obviously you can sell them, and you sell them, you make money. And some NFTs also have this royalty agreement. So every time that NFT gets sold to the next buyer, the initial creator gets paid like a royalty, and that's another functionality that you see on some NFTs.
Yeah.
Yeah.
So Shehan, if an artist gets royalty, then that would be treated as ordinary income as and when he earns it, right?
Yeah, I mean, if you're an artist, if that's your trade or business, it's considered ordinary income. Yes.
Okay. So just to go over how NFTs are taxed, there are two buckets, right? You could be creator of the NFT. That means you actually are the artist behind the NFT, or you are an investor. You're just, buying and selling NFTs. So if you are a creator, you can deduct some of your ordinary and necessary expenses, which you incurred in creating the NFTs. You have to report them as ordinary income, and it would be subject to self-employment tax. So that's if you're a creator, ordinary income, you can take it, expenses as a deduction, and then it would be subject to SE tax. On the other hand, if you are an investor, right, so it's all you do is buy and sell these NFTs on exchanges, then you will get a capital gain and loss treatment. And depending, if you hold the NFT for less than a year, it will be a short-term capital gain. If you hold it for more than a year, it would be long-term capital gain. So again, at the beginning of the presentation, we said that long-term capital gain could be now essentially taxed at 25%. So that would be your tax rate. And then if it is short-term, whatever ordinary rate income tax bracket you are in, that would be the rate where your short-term capital gain would be taxed. So Shehan and I were having a discussion, whether NFTs, collectibles are something which IRAS has a special tax rate on, if it is any form of artwork and stuff like that, instead of paying the long-term capital gain, essentially it was 20% till, about September 13th. And if the act goes through, then it will become 25%. But this collectible could be taxed at a higher rate of 28%. So we need to keep that in mind that certain NFTs, if it's in the form of art, could probably be taxed at 28% instead of your 25% long-term capital gain. Something which Shehan mentioned, like a domain name as an NFT, that I think would probably be still taxed at 25%. Shehan, your thoughts?
Yeah, I agree. Not every NFT is considered art and therefore a collectible. NFTs that are not considered collectibles could have the same treatment as regular cryptocurrency, which is treated as a property.
Yeah. I mean, hopefully you are making money when you're buying and selling this NFTs, but if you're just doing it as hobby, and let's say if you're losing money, then you could potentially run into hobby loss issues. So hopefully, if you are buying and selling, you're making money and you will never run into this issue. Okay, so we just wanted to go over an example of NFTs and the different buckets you could fall into. So let's say I'm a creator and I made $1 million selling an NFT. Because I'm a creator, it's going to be ordinary income. I'm in the highest tax bracket, let's say 37%. My tax due would be $370,000 plus any SE tax plus, I'm a resident of New Jersey, so New Jersey is going to tax it as well. If I'm a short-term investor, the same thing, 37% bracket will apply. In this case, it would be $370,000 plus my net investment income, if it could be 3.8%, and then any state taxes. And let's say if I am a long-term investor and I am invested in an NFT, which is a collectible, and I sell it, the tax rate there would be 28%, and again, it would be subject to net investment income and my state taxes. So that's a short recap of how NFTs would be taxed. The next few slides is, to buy an NFT, generally you need Ethereum. You just cannot buy NFT with US dollars. You need Ethereum. So let's say I have Ethereum and now I'm ready to buy my NFT. Remember that these virtual currencies are actually property. So the moment I buy NFT with my Ethereum, it is treated as if I sold my Ethereum and then I bought the NFT. So that becomes a taxable transaction. So just to give you an example, if I bought something, if I bought a Ethereum at $500, last year, now I'm using the same Ethereum to buy an NFT, one Ethereum. Ethereum right now is about 3,000 or 3,300. The difference between the 500 and the 3,000, the 2,500 will be a capital gain transaction for me. So people don't realize that. And then I think Shehan, the issue is how do you track all this and how do you keep good books and records, because there are some taxpayers who are probably doing this 100 times a month.
Yeah, so I guess the record keeping is, I would say, virtually impossible if you have to do this manually, because there's so many transactions that's happening, and we previously covered about the wash sale rule and the constructive sales rule. Imagine kind of figuring out those things and do it manually. So just know that there are tools like, for example, like CoinTracker.io, which kind of helps you aggregate all your transactions by connecting to your wallet and exchanges, and then it just kind of gives you the capital gains and loss report, which you can directly import it to your tax software, or you can give it to your accountant as well. So yeah, I mean, it's okay to do all these transactions, but I encourage you to use some type of tool to kind of track these automatically. Otherwise, it's going to be really hard for you.
Yeah. So here I think the point is to, it's not the same as, you're walking into a store, you're buying a painting and you're walking out. There it's not a taxable transaction, but here, because Ethereum is involved and you are using your Ethereum to buy the NFT, it becomes a taxable transaction. So a few of the clients were saying, what if you donate this to a charitable organization, a qualified charitable organization? What kind of deduction would you get? So if you are an investor and you've held it more than a year, the NFT, the deduction you could potentially get is the fair market value. But if you hold it less than a year, it could be the lesser of your basis in the NFT or your fair market value. But if you are a creator and you're donating it to the charity, the amount of deduction would be limited to your tax basis, which would be, I think, minimum, right? Maybe whatever you spend to create the painting, I don't know, virtually, I don't know what kind of cost would be involved, but I think it would be limited to just that. So now getting into loans against, can you earn interest by actually loaning your cryptocurrency? And I think, Shehan, this is a new trend which a lot of people are getting into, because I think the interest rates could be really, really lucrative, from maybe 5%. So I think yesterday you were telling me up to 18% of interest can be earned on your crypto. So what are your thoughts on actually doing this?
Yeah, so if you have appreciated cryptocurrencies, there are now a handful of centralized platforms like BlockFi and etc. And also decentralized protocols where you can kind of lend your crypto as collateral and get a USD loan against that. Actually, I'm sorry. So there's two sides to the story, right? Some people are giving money to provide liquidity, and some people are borrowing money. So there's two sides. Now, when you lend your crypto to some of these platforms, so those platforms can go provide liquidity to other market participants. You're getting interest from the platform because you're lending your money to provide liquidity to the other market participants. So this trend has become pretty popular because if you take a look at savings account interest, they're they're very low. But here, depending on the coin, sometimes even you can get like 12-13% APY, annual percentage yield, and with the minimal amount of risk. I mean, obviously there's risk because if the platform gets hacked and stuff like that, your funds could be compromised, and these are not like FDIC insured type of financial instruments. So there's a risk. But I see a lot of people who got into crypto space like so early. They don't necessarily want to sell their crypto holdings to trigger a capital gain. Instead, they just put their holdings in some of these platforms and earn passive income in 10, 12, 20, 12% interest.
Yeah. So again, I mean, you are earning interest on this crypto, so it will be generally taxed as interest income, and it will be subject to ordinary income tax rates. I'm going to launch another polling question. The first commercial Bitcoin transaction was for what was the first commercial Bitcoin transaction? I have about 40% of the votes in. A lot of people are actually guessing as gambling. I mean, that would make sense, but okay, I'm going to close the poll. Yeah, the first one was for the pizza, and I think it was Bitcoin which was used for that. Another trend which we have seen is some of the taxpayers or some of our clients are actually even borrowing against the crypto, right? So I have Ethereum right now. It's at 3,000. I predict it to go up to 10,000, right, Shehan? That's our next prediction. We made 2 predictions today that it may go up to 10,000, and I'm not willing to part with my Ethereum. But since I have made all this money or all this unrealized gain, I would now want to maybe buy a house, take a vacation, and stuff like that. So, are you seeing the trend that people are actually borrowing against the crypto a lot?
Yeah, I mean, a lot, because people who got into this space, let's say like 5, 6 years ago, now they're sitting on a very large amount of unrealized gains. And if they want to buy a house or maybe pay off their debt or need money to invest in a investment property like real estate and etc., this is a great way for you to kind of get cash liquidity without triggering a taxable event. So yeah, there are a lot of platforms that allow you to do this very easily. This space has grown so fast, like you can get like $1 million+ loan without ever having to go through like an intermediary, or without ever having to expose your social security number, or without ever having to run any credit. So that's what this whole decentralized financial system is all about.
And how soon do you think, Shehan, that how soon can you get these loans? Like
It's instantaneous, to be honest with you. It obviously depends on the platform. There are some centralized platform that does some amount of KYC. But if you have a large amount of Ethereum, like there are so much decentralized platforms, you just put your crypto as collateral, and then instantly your whatever the other coin gets credited to your wallet, that you can do whatever you want with.
Yeah. So as we summarize on this slide, what are the thoughts behind doing that is, your cryptocurrency keeps appreciating. You avoid capital gains tax, at least at that particular moment. If you had to sell your cryptocurrency and then use those funds to buy a house, you would actually liquidate your cryptocurrency, and then it would be a taxable event whereby you would pay capital gains tax. So if you're borrowing against it, at that time, at least you are avoiding the tax. You can reinvest your borrowed funds however you want. You're not taxed on your debt. And then, if the interest, depending on how you use the borrowed funds, some of the interest could potentially be deducted. So let's say if I'm using to buy a house, and if it's within the limitation, then I could potentially deduct some of that interest as an itemized deduction. But I think the key thing here is that, okay, I've taken the loan, all is good. I have avoided capital gain gain, at least at that time. But what happens when I sell the crypto to pay off the loan? At that time, it becomes a taxable transaction, because essentially you are selling off the crypto at that point. I am going to launch another polling question just to catch up. I think I'm one polling question behind. Which of the following companies does not allow customers to pay via Bitcoin? Which of the following companies does not allow customers to pay in virtual currency? I have about 82% of the votes, and I'm just going to close it in 3, 2, 1. Share the poll results. And I think 51% of you got it right, that AT&T does not accept Bitcoin as yet. So another thing, in addition to borrowing against your crypto is now a lot of these exchanges, like even Coinbase, have started to issue crypto credit cards. So every time you use these credit cards, you actually get rewards in cryptocurrency. Shehan and I actually had mentioned in one of the CNBC article that our thought process was that it's essentially treated as as a discount or a rebate, like a normal credit card. If you get cash back, it's not taxable because it's treated as a discount on your purchases or a rebate. So we think that probably a similar position could be taken on crypto rewards, and they would not be essentially taxable when you get it. But of course, when you sell it, you will pay capital gains on that. Shehan, would you like to add anything on that?
No, I mean, in addition to what you said, like, I guess this is one of those few ways to earn cryptocurrency without triggering a taxable event. Yeah, so I mean, if you have the opportunity to have a card that allows you to get crypto back instead of cash back, yeah, it's a good way to earn cryptocurrency without paying taxes.
Okay. The next thing which we are going to get into is crypto theft losses. I think it's pretty common in this space that the wallets get hacked, or the exchanges get shut down, or there are some other unfortunate events. So I actually had a situation where somebody told me that they had invested in something really small at about $500. They sold it and they recognized a gain of about $1.5 million, and then they reinvested that gain into another coin. And then within a couple of months, that coin or that wallet was hacked. So they made $1.5 million, but they reinvested it and it was hacked. So what is their recourse? Because the gain was already realized and has to be recognized on the tax return, they still have to report it as a capital gain. But what is their recourse? So theft losses, right? Currently they are disallowed to 2025 unless if they happen in a disaster area. If your wallet is virtual, I'm not sure if you can really claim that it was a loss in a disaster area unless you have like a hard wallet and something happened to it. But essentially it is, right now, I don't think you can get a deduction, any deduction under theft loss. Abandonment loss, I think it's only for businesses, and it's basically, if you had maybe created a coin, you were planning to launch it, and essentially something happened, and you couldn't, do a mainnet launch, maybe you could take that loss as an abandonment loss. But other than that, I'm not sure what other recourse a taxpayer could have. Shehan, your thoughts are a little different on this?
It all depends on the facts and circumstances of each case. In my view, I mean, there are some criteria that you need to meet to have an abandonment loss. So, for example, say that you spend like, I don't know, 100,000 or whatever in some type of coin, and on the next day the value went down to zero because you find out this is like an exit scam. So there's no business. So essentially you got scammed. Or in another case, value went to zero for whatever the reason. So now going forward, this coin doesn't have any value. These type of incidents are pretty common in the crypto space. In those cases, depending on your facts and circumstances, the proof of documentation that you have, you might be able to claim that loss under abandonment loss provision. But again, it's hard to say, it's hard to generalize that all those things could be treated as an abandonment losses, but there's a possibility.
Yeah. So I think one more thing to point out here is, if you have such a big realized gain, just make sure that you set aside money for your taxes, because that tax bill is definitely coming sooner than later. So that's key. Just don't reinvest it all in something, or just talk to your tax professional before you make any decisions. And I think year-end planning for a lot of the clients would be very, very important if they have made significant gains during the year. Before we get into the last portion of this presentation, the digital assets and some of the tax planning strategies, I'm going to launch another polling. Actually, I just have one more, so I'll just wait. We'll wait till the end of the presentation to launch it. So there are a lot of people who have made significant amount of money, or their net worth has increased significantly overnight, right? So they are looking for tax planning strategies, and what can we do to maybe reduce the tax bill? And I think the first and the most easiest thing is, and if possible for you, would be residency, right? So Shehan lives in California. California has a 13.3 state tax rate. So, if Shehan is planning to sell, let's say, Bitcoin worth $2 million, which he got at maybe $1,000, he's going to have significant gains. So Shehan can think about, maybe, what if before I do this transaction, let me change my residency, right? So Shehan, 13.3%, if you move to Texas or Florida, could be potentially avoided, right?
Yeah, as a matter of fact, a couple of years ago, I was living in San Francisco, but I do live in Texas now.
Yeah, so now you know why Shehan moved from San Francisco to Texas. Now, Shehan, another thing is, before the sale, if you really even want to save federal taxes, right? Would you consider moving to Puerto Rico? Because that's the next step, right? You avoid your state taxes, and now you want to even save on the federal taxes, because Puerto Rico has a provision whereby they don't tax, capital gains. So,
I mean, it's a big move. I mean, personally, I wouldn't do that. I don't think it's worth doing it unless you have, I don't know, maybe gains in my book, gains in excess of 100 million. In that case, it would make sense. Anything below that, I feel like there's so many things that we can do within the U.S. tax structure to minimize the tax bill.
Okay. And I get asked this question. I mean, actually, I was asked this question on one of the calls, is that, can I just open a PO box in Texas, not actually go there, a PO box address, not actually go there, and can I get this tax benefit? And the answer to that is no. You actually have to physically cut off your connection with your prior home state. In this case, would be California. You have to move all your belongings, everything that is near and dear to you, your driver's license, your doctors, everything has to be moved, because California can always come back and say that you never intended to actually leave the state. You are still connected to my state, so you still have to pay the 13.3%. The other argument is, okay, what if I move to Texas for a couple of months, I do the transaction there, and then I move back? What's your thought on that?
I don't think it's gonna work. I don't think it's a bona fide change of residency.
Yeah. So I mean, keep that in mind. If you are planning to change your residency, you have to make sure that you, really do all the steps that are necessary to change the residency. Otherwise, the states, especially like California, especially like New York, will always come back and say, no, you always were here, you're still a resident here, and we are going to tax you on this huge gain. The next part of the tax planning strategy is, self-directed IRAs. You cannot make cryptocurrency investment in a traditional IRA or a Roth IRA, but it has to be a self-directed IRA. So you can potentially, open up a self-directed IRA, make your contributions there, specifically if, the token or the coin is at real less value at this time, and you think that there could be significant appreciation in the future. You could probably do a Roth IRA contribution, and at least till the window is open. And if you're making more than $400,000, at least till the window is open. Retirement plans, again, you could probably get into cash balance plans, into SEP, depending on the type of entity you have. That's a potential, you're saving for your future, as well as, taking a tax deduction currently. State planning is really important. Take advantage of the lifetime exemptions. They are still $11.7 million as of now. They are slated to go down to around 5.5 if this act passes. So that's also a key way to do it. And the trust can also be created so that you're protecting it from your creditors and the government. So trust does provide you that kind of protection. So if you don't want to do it for other reasons, maybe protection is one of the reasons you would want to think about that. I did not mention R&D credits on this slide, but if you think that you're making significant, you're putting in significant amount of dollars for research and development and maybe creating something or stuff like that, you could probably even explore the possibility of R&D credits. For a C corporation, the credit is taken at the entity level, and if you're a S corp, a partnership, they will flow through to you on your K1, and you could potentially take it on your individual tax return. Two other things before we get into any other discussions or questions would be opportunity zone funds. So this provision was created a couple of years ago, basically that if you have eligible capital gains on sale of stock, bonds, crypto, or maybe a qualified 1231 business use assets, you could defer the gain to 2020 to 2026. So let's say if I sold my crypto, I made $1 million out of it again, I can defer the gain to 2026, but it must be recognized in 2026. So essentially, I'm getting a 5-year deferral for the gain. But what do I have to do to get this deferral, right? First of all, I cannot sell it to a related party. That, okay, I'm selling it, let's say, to my daughter, and then that will not work. The funds have to be reinvested in a qualified opportunity zone fund within 180 days. So these are the different funds which or regions that the IRS has identified, saying they need to do really development in these areas, and if you invest in any of the residential projects, commercial projects in those areas, you could potentially defer the gain. So let's say if in my example, I made $1 million, and now I invested in the same $1 million at this qualified opportunity zone fund. I keep that investment for 10 years. So in 2026, I am going to pay tax on the $1 million, right, which was my original gain, and then any appreciation, if I hold the property for 10 years, let's say if that $1 million, which I invested in the qualified opportunity zone, becomes $5 million at the end of 10 years, that appreciation is tax-free. The state treatments on some of them could be different, but essentially, I paid tax on the $1 million, but any future appreciation, if I invested that in the qualified opportunity zone, could be tax-free. Shehan, are you seeing people doing that a lot? I mean, it's a good way of diversifying also, right?
Yeah, this is common, especially among high net worth individuals. I would say anytime you want to recognize, or I would say $500,000 worth of capital gains, then this type of strategy makes sense.
Yeah. So, I mean, that's another strategy, if you're differing. And then in this case, you're also diversifying your portfolio. You're not in this volatile crypto market as well. And then the last piece of this would be, IRS has said that you can actually pick and choose the lots you want to sell. It's almost like the similar form in stock. If you can identify the crypto exactly on the time and date, you can actually pick and choose what you thought was sold. So let's say if I have Ethereum, which I bought at 500, I have Ethereum, which I bought at 2000, and today I want to sell Ethereum when it's around 3000. So I can say, if I can identify the actual currency at that particular moment, I can say that I did not sell the one with 500, so I don't have to, recognize the gain of 2500, but I sold the one which I bought for 2000. So that is the specific identification. In that case, I'm only going to pay tax on the $1,000 of the cryptocurrency. So I think Shehan, some of the softwares actually do a HIFO method, which is highest in, first out, and that method is permitted. I think the only thing is you have to be careful if it's going to be short term or long term, depending on when you bought it, right?
Yeah, so HIFO is pretty powerful, and this is actually a great tax planning tool for tax practitioners, because if you really think about the stocks and securities, by the time you get the 1099-B, the tax identification method has already been done. So as a tax practitioner, there's nothing you can do to optimize your client's tax situation. But when it comes to crypto, you can use, tools like CoinTracker and kind of sit down with the client, every quarter or whatever, and see which taxless ID method is suitable for that client. 99% of the time, HIFO works because essentially you're selling the most expensive unit, so you're naturally recognizing the less delta between the sales price and the cost basis. But there could be some situations where maybe FIFO could be useful. Maybe your client is taking a year off from work in the next year, and they're going from 37% bracket to potentially 0%. In that case, you might want to unload those in a low basis coins to recognize gains, because the eventual tax bill is going to be lower because your client is going to a low tax bracket year. So I think this is one of the very powerful tax planning tool. In my opinion, I think it's only available in the crypto space, because in the stock world, by the time you get a 1099B, this identification has already happened. So there's nothing you can do from there.
So you think that once the exchanges start issuing the 1099Bs on the crypto side, would this advantage go away?
I don't think so, because exchanges only have visibility into what's happening inside their exchange. The specific identification, the lot identification needs to happen at the taxpayer level, because the taxpayer has visibility into multiple exchanges and wallets and etc. So I don't think exchanges will do this. Exchanges will just print the sales prices and cost basis if available, just to kind of satisfy the IRS requirement, because otherwise they get penalized for not issuing any 1099Bs. And the taxpayer is going to get all those incomplete 1099Bs, and they will have to reconcile at the taxpayer level to figure out the capital gains and capital losses.
Yeah. And then with the increase in the tax rates, right, with the potential increase in the tax rates going from 20 to 25% this year specifically, I think it would make sense to actually look, if you want to actually recognize more at a lower tax bracket. What are your thoughts on that?
Yeah, I mean, especially if you're a high net worth individual, so you have 25%, hopefully, potentially starting next year, at 3.8 net investment income tax, at 3% surtax, so and plus maybe state income tax as well. So yeah, depending on your situation, it makes sense to kind of sit down with your tax practitioner and see what you want to do in the Q4. Maybe you want to take some money out, subject to a lesser capital gain tax rate, and yeah, something to think about.
Yeah. We don't have much time for questions, but if we did not really answer your questions here, we do have all the questions in the queue. I think one common question that was asked was, will the slides be shared? Yes, if you had registered for the webinar, you will get a copy of the slides as well as the recording of this webinar. So that will be emailed to you generally within 28 to 48 hours. I'm going to launch the last polling question. And I think if you were paying attention to the webinar, you probably know this. I have about 10% of the votes in. If you're looking for CPEs, this is the last polling question. I'm going to give it about 10 more seconds. Okay, closing the polls and sharing the results. At one point, it was 100% people had got it right, and then I started to get in some more answers. So yes, it was $69 million. So if we were not able to answer your questions, we will definitely get back to you via an email and try to respond to any of the questions you had asked. Shehan, thank you so much for doing this presentation for us and sharing your insights about the industry with us. So really appreciate that. And then with that, we come to the end of this presentation. Thank you.
Thank you.